Good morning, friends. We are going to start bond valuation topic. It is one of the very important topics of your syllabus. Okay. And in the exam, the weightage can be somewhere between 6 to 16 marks. Up to 16 mark questions have been asked on this topic. And it is one of the simplest topics that you can have. But subject to your understanding is clear. Even in May 2023 exam, there was questions on bond valuation topic. Is it right? So please keep replying to whatever I am asking. That will make the classroom interesting. Those who are in the classroom, those who are online, please keep replying to the queries. So my first question is, what is a bond? What is a bond? Is it a debt instrument or is it an equity instrument? Is it a debt instrument or is it an equity instrument? Is there any compulsory obligation to pay interest redemption, or there is no obligation to pay interest and redemption? So what is your query? What is your answer? It's a debt instrument. Very good. So bond is a debt instrument. It is usually a long-term instrument. Long-term means the maturity period is very high, about 5 years, 10 years. Some company issue bond for 15 to 20 years also. Is it right? So bond is a long-term debt instrument. What do you mean by debt instrument? Debt instrument means the company which is issuing the bond has an obligation to pay the interest and the principal, or whatever cash flow they have committed to pay. They can commit to pay either interest or principal or both. In some bonds they commit only to pay interest. That is called perpetual bond. In some bonds they commit to pay only the principal. That is called zero coupon bond. And in other bonds they commit to pay interest as well as principal amount. That means the one who has issued the bond, they tell the holder of the bond that these are the cash flows I am going to pay you on these dates. And that is an obligation to pay. It cannot be avoided. Then such instruments are called debt instrument. Can it be secured or unsecured? Bonds are usually secured, but bonds can be unsecured also. Secured bonds are issued by government, public companies, private companies. Okay. Secured means in case if the company defaults in repayment, the assets of the company can be sold. Is it right? And unsecured means there is no security. But if the company goes into liquidation, they will receive the amount as unsecured creditor. They will not get any preference, but they will receive their amount as unsecured creditor. Unsecured bonds are usually issued by private enterprises. Now I am going to tell you about basic features of a bond. First 5-10 minutes we are only going to start the concepts, develop the basics, develop the concept behind it, and then you will be able to understand. So basic features of the bond, paragraph 2 in your book is, first, it is a debt instrument issued by government, companies, public sector undertaking, banks, and highly rated companies. Highly rated companies means those which have got good rating in the market, good credit rating in the market. That means they are not likely to default. They are not likely to default. That is highly rated companies. Like for example, Tata Motors have issued bond, Reliance have issued bond, because they are highly rated companies, and of course Government of India keeps on issuing bonds. The rate of interest is called coupon rate. So please keep in mind, in this chapter we are going to use the term coupon rate. Coupon rate means interest rate. Then bond can be redeemed at par or at premium. That will be mentioned in the document that is used for issuing the bond, prospectus, that this bond will be redeemed at par, this bond will be redeemed at premium. Now tell me, what will you do if the question is silent? whether it is redeemed at par or premium. What will you do if the question is silent? Par or premium? Yes, par or premium. So one student has answered it will be redeemed at par if question is silent. Then there is another type of bond which is convertible into equity share. They are called convertible bond. So we have a special section on convertible bond in our notes. Then there is another type of bond on which interest is not paid. No coupon is paid. Then why will you invest in this bond? These are issued at a huge discount and they are called zero coupon bond. Is it right? So if the face value is 1000 rupees, the issue price will be 800 rupees. You invest 800, you will get 1000. So the difference 200 is the income of the bondholder, is the return to the bondholder. Is it right? The position of bondholder. So Anup is right that bonds will be redeemed at par if question is silent. What is the position of the bondholder? Is he like a creditor or is he like a equity shareholder? Position of bondholder is like a creditor or like an equity shareholder? Creditor, because the company has the obligation to pay. To equity shareholder there is no obligation to pay. Is it right? The second reason is that bondholders are not the owners of the company. Just like creditors are not the owners of the company, bondholders are not the owners of the company. They cannot participate in decision making. They cannot participate in annual general meeting or any extraordinary general meeting. They simply have a right to receive the interest and the principal. Who is the ultimate owner of the company? The equity shareholders are the owners of the company. What is the advantage of investing in a bond compared to equity share? Bonds are less risky. Equity shares are more risky. Why? Because in case of bond you will get a fixed coupon amount, redemption amount on the pre-decided dates. In equity share, neither the dividend is certain, nor the redemption value is certain, nor the market price is certain. So therefore, the risk of bondholder is less than the risk of the equity shareholder. So those who don't want to take high risk, where they will invest? Bond. Those who want to take high risk, they will invest in equity share. Okay. One advantage of being a bondholder or a debenture holder is, in case if the company fails to pay interest and principal amount, you can go to the court. Court will order that the company's asset should be sold. Company should be wound up in extreme cases, and the amount realized will be used to pay the bondholders or debenture holders. Okay. Come to next paragraph, number 3, reasons for issuing bond. Reasons for issuing bonds. Why do government and the corporates issue bonds? Reason number 1, in India or in other countries, government is a big time borrower. Government is a big time borrower. Is it right? They will borrow huge amount of money. How do they borrow money? By issuing bond. But why do they issue bond? Because they have to incur expenses. There are a lot of military expense, administrative expense, okay, health care expense, and from where will they meet? By raising funds. So funds are raised by issue of bond. Second reason why bonds are preferred over equity share is bonds are cheaper compared to equity. Interest rate is lower than the dividend that they have to pay. Not only that, interest is a tax deductible expenditure. When you pay interest, you can claim it as an expense in your tax return and your tax liability goes down. So it is called tax deductible expense. Dividend is not tax deductible expense. If you pay dividend on preference share or equity share, then you don't get it as a deduction. But if you pay interest on bonds, debenture, you get it as a deduction. So that reduces the effective cost of debt. And that is why also debt is preferred by the companies. Third is, company can benefit from financial leverage. What is the meaning of financial leverage? Financial leverage means your return on capital employed is more than rate of interest. Financial leverage means return on capital employed is more than rate of interest. So you will borrow money at 10% and use that money to earn 15% return. Use that money, start a business, earn 15% return. But to the bondholder, you are going to pay 10% only. So the extra 5% return that you earn belongs to whom? Belongs to equity shareholder, to the owner. That is called financial leverage. Use of debt to increase the return of equity shareholder. Use of debt to increase the return of equity shareholder is called financial leverage. So therefore, some companies which think that their business model is strong, they can generate huge amount of profit, they would prefer to go with bond route so that they can get the benefit of financial leverage. It will increase the return to equity shareholder. And another reason why bonds are issued, the bondholders do not have voting rights. The bondholders do not have voting rights, and therefore there is no dilution in the control. Control remains with the owner. You are able to raise funds, but without diluting the control. Control remains with the owners. So that is another reason for issuing bond. So this was some basic background I have created. The real chapter starts now. Now you have to be very attentive. Important terms used in bond valuation. Paragraph 4. Important terms used in bond valuation. Keep the notes in front of you. Okay. If you have any query, you can ask me. Anybody, any query? No query? Anup, Soumya, Divya, any query? So first we will start with important terms used in bond valuation. Okay. First understand, the first basic term is face value. Face value or par value. Every bond has a face value or par value. Usually bonds are issued at par value. So what are the par values you will see in case of bonds? 100, 1000. Some company issue bonds with face value 10,000 also. Some company issue bonds with face value 1 lakh also. And some company even issue bonds with face value of 10 lakh also. So that company will decide. Accordingly, the number of units will change. If they want to issue more units, face value will be less. If they want to issue less number of units, the face value will be more. Sometimes they want to issue to selected investor only. So they issue bonds with a higher face value. Now we are not interested. We will be given this number in the question. Is it right? We will be provided with these numbers in the question. So what you will do now, what is the relevance of bond face value in the bond valuation is that whenever you will calculate the interest will be calculated on face value. Interest will be calculated on face value, not on the issue price. Issue price can be at premium. Issue price can be at discount. Okay, not on the market price of the bond. Interest will be calculated on face value of the bond. That is the relevance of face value. And if nothing is specified, as we have discussed, redemption will also be at face value. Second concept is coupon rate. Coupon rate means the rate of interest as determined by the company and agreed by the investor that the company is going to pay this rate of interest. So for example, if it is mentioned 9% bond, what does this 9% indicate? Please reply, what does this 9% indicate? This 9% will indicate that the coupon rate is 9%. Company will pay interest at the rate of 9% on the face value. So this is called interest rate. This rate is mentioned on the certificate. Nowadays physical certificates are not there, but earlier there used to be physical certificates. Okay, when you invest in a bond, you will receive a certificate which will mention 9% interest rate. That is also called coupon rate. So we will use the term coupon rate or interest rate interchangeably. So when I am saying coupon rate or I am saying interest rate, it means the same. Now, advantage of issuing bond to the company is that interest is tax deductible. So if it is paying 9% interest and tax rate is 30%, please reply fast. What will be effective rate of interest considering the benefit of taxation? Please reply fast. 9% is interest rate, tax rate is 30%. You will save 30% of 9. So 9 minus 30% of 9, which you can write as 9 into 1 minus 0.30. Use your calculator. One student has replied, Divya has replied 6.3, Anup has replied 6.3, seems to be right. Wonderful. But if you are an investor, you have to pay tax on that. Investor has a disadvantage. If he receives 9 rupees income and suppose he falls in 30% tax bracket, then he will have to pay 30% tax. So his effective income will be 6.3%. But for the company, the effective cost will be 6.3%. So in this question, in some problem, in this chapter, in some problem, we have taxation issue also. Okay. If you are a company, assume that you will get tax shield. If you are an investor, you have to assume you have to pay tax on the interest income if taxation is given in the problem. Now next concept is coupon payment. What do you mean by coupon payment? Coupon payment means periodic payment of interest. Is it right? So if it is a 5-year bond, year 1, 2, 3, 4, 5, and suppose the coupon payment is annual, then every year the company will pay 9 rupees interest on 100 rupees face value. Every year they have to pay. So coupon payment represents periodic interest payment from the bond issuer to the bondholder. Now if it is a semi-annual bond, what will happen? If it is a semi-annual bond, then every year coupon will be paid after 6 months. Coupon will be paid after 6 months. So you will pay 4.5, 4.5, 4.5, 4.5, 10 times you have to pay. So now will you assume annual coupon bond or semi-annual coupon bond? If the question is silent, I have written a note that you will assume annual coupon bond if the question is silent. Is it right? If the question is silent, we will assume annual coupon paying bond. If the question specifically mentions semi-annual coupon paying bond, then we are going to take semi-annual coupon paying bond and we are going to calculate coupon every 6 months. Is it right? Now next concept is maturity date. What is maturity date? The date when bonds will be redeemed. Only one bond does not have maturity date, that is called perpetual bond. Perpetual bonds do not have maturity date, but other bonds will have a maturity date. On the maturity date, the company will redeem the bond by paying the coupon, whatever coupon is outstanding, plus the redemption value. Coupon plus redemption value is paid on maturity date, and then the bond will be removed from the books of the company In the language of accountancy, the bond will get derecognized from the books of account of the issuing company. Is it right? The investor will receive all the outstanding from the company and then tata, bye bye. Next is original maturity. Original maturity means suppose the bond was issued on 1st January 2021 and it will be redeemed on 31st December 2025. So what is the original maturity? This is the maturity date. Count the number of years: 31, 12, 21, 22, 23, 24, 25. So original maturity in our example is equal to 5 years. Original maturity in our example is equal to 5 years. Original maturity means from the date of issue you will start counting and till the date of redemption you have to count. Be very careful with the wordings in the question. Original maturity means you will count from the date of issue till the date of redemption. Okay. So original maturity, I have written this definition: time remaining until the maturity date when the bond was issued, and the example is this: 5 years from the date of issue. Then there is something called remaining maturity. Very important, right here, very important. Very important. Okay. Suppose the bond was issued on 1st January 21. Bond will mature on 31st December 25 and today is 1st January 23. Now you are standing here. Suppose this is you. Okay. So you will look forward. How many years are remaining? How many years are remaining? 23, 24, 25. So how many years are remaining? 3 years. So we will say remaining maturity is equal to 3 years. And for all calculation purpose, if you have to find the value of the bond on 1st January 23, you will have to look how many years are remaining. 3 years are remaining. 3 cash flows are pending. Redemption will be after 3 years. So for all calculation, I will take 3 years. Don't look behind. Don't look behind. Look in front. Don't look behind. Look in front. Okay. Only you have to look in front and accordingly do the calculation. That is the concept of remaining maturity. Because whatever has happened, whatever cash flow has been given, that will not affect the value of the bond now. Is it right? So the current time currently remaining until the maturity date. So this is the example. The bond was issued on 1st January 21, but if I am paying for the bond on 1st January 23, I will look at what are the cash flows which are remaining now. So 3 years are remaining and whatever cash flow you will get in 3 years, those will be considered in your calculations. Is it right? Now next is required return. Required return means rate of return required by the investor. Depending upon his assessment of the risk, depending upon his other opportunity options, he will think that this bond should give so much return to me. That is called required return. Rate of return required by the investor. Is it equal to coupon rate? Please reply. Option A, yes. Option B, no. Whether rate of return required is equal to coupon rate, yes or no? Or point number C, maybe. Not necessary. Very good. The answer is not necessary. Okay, it can be equal to, it may not be equal to required rate of return. Because bond was issued, let's say 5 years ago. 5 years ago the economy was booming, interest rate was low, but now you see the interest rates have gone up everywhere in the world. So now you have other option where you can invest at a higher rate. So your required rate of return today will be higher, and reverse can also happen. Therefore, required rate of return may or may not be equal to coupon rate. So what is the importance of required return here? The investor will calculate the value of the bond by discounting the cash flow of the bond using required rate of return. If you discount the future cash flow using required rate of return, is it right? You will get the present value of the bond. So we are going to apply required return for calculating the present value of the bond. Required return is used for taking decisions. If a bond is generating a return more than your required return, welcome, 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 we are going to buy that bond. But if the bond is generating a return less than your required return, then go away. I don't need you. Is it right? So that is the required return concept, and I am going to extensively use in our answer. Now the next is redemption value. Very easy. Redemption value means the amount which the bondholder will get on maturity date. So redemption can be either at par or premium or at discount. Now the question I am going to ask, if the institute is silent about redemption value, if the question is silent about redemption value, what will you assume? Par, premium or discount? Reply fast. Par, premium or discount? Par, premium or discount? Yes, students are not replying. One Mr. Hari is totally silent. At par. Anup is right. Hari is right. Divya is right. So at par. So please keep this in mind, because we are going to solve many questions and they don't specify redemption value. So we are going to redeem at par. So this was some basic introduction. Now we'll come to types of bond. Keep the notes in front of you. Paragraph 5. I have mentioned some examples of types of bond. There can be more than this. If you remember, in your intermediate syllabus, there was a chapter called types of financing. Do you remember types of financing? Intermediate FM, types of financing. How many of you remember? Say yes. There you have learned different types of bond. Masala bond, samurai bond, okay, etc., etc. So there are many. But for us, for numerical questions, I have classified the bonds into these categories for solving numerical question. So one is coupon bond, perpetual bond, self-amortizing bond, zero coupon bond or deep discount bond, option bond, inflation bond, floating rate bond, option tender bonds. Now we are going to discuss one by one each of them. Okay, so be very attentive, because now the time has come to start solving some questions. So the first type of bond is called coupon bond. Sir, what is coupon bond? Coupon bond means those bonds which pay periodic coupon. Those bonds which will pay coupon either quarterly or half yearly or yearly. Usually bonds pay semi-annual coupon. But for the student, if the question is silent, we will assume annual coupon payment. So they will pay coupon every year, and on the maturity date they will redeem the bond at usually face value or par value, but sometime the redemption can be at a premium also. Is it right? Second type of bond is called perpetual bond. Perpetual. There is no maturity date. So you will not get your principal. Then why will you invest in a perpetual bond? Why would you invest in a perpetual bond when they are not going to give you back your principal? They will pay coupon every year. Correct. They will pay coupon every year. So the perpetual bonds do not have maturity date, but they pay coupon at a specified period of time, interval. We will take question on perpetual bonds also. The third category, self-amortizing bond. Self-amortizing. Suppose First understand the concept. Face value is 1000 rupees. Everybody participate. But the company says we are going to redeem the bond in 4 installments. This 1000 rupees we are going to redeem in 4 installments. Year 1 250, year 2 250, year 3 250, year 4 250. So where the principal amount will be redeemed in installments. Self-amortizing. The principal amount is redeemed in installments. The principal amount is redeemed in installment. So what will happen to the interest? Please reply. I want to test your knowledge. Whether the interest will remain same or interest will keep falling every year. Whether interest will same or interest will fall. So answer is interest will keep falling. Is it right? So interest will keep falling because every year the balance is reduced. So Anup Bapat is right. He is saying interest will fall. Divya is also right. Wonderful. So it will pay a fixed amount each payment period over the life of the bond. So I am going to take few questions on this type also, which was asked in RTP. Principal amount is repaid in installment rather than on maturity. They will mention in the problem what is the frequency of redemption. Whether it will be redeemed in 3 installment or 5 installment or 10 installment will be provided to you. Now the next concept is deep discount bond. This was issued by IDBI long back, and what was the scheme? That today you invest 2700 rupees and after 25 years you will get only 1 lakh rupees. How much is the discount? Discount amount, 1 lakh face value bond, they are issuing at 2700. What is the discount? Come on. What is the discount? 97,300. 97,300. Very good. So students in the class is saying 97,300. Even online students are saying same. So 97,300 is the discount. That is what is called deep discount bond. But how many years you have to wait? 25 years. This 2700 is the present value of this 1 lakh rupees. And if you calculate the rate of return, it comes to something around 15%, but we'll do it later. It's not that you're not getting anything. You're getting a annual compounded rate of return of approximately 15%. So if you earn 15% every year, after 25 years, this will become equal to 1 lakh. It was called deep discount bond. They do not pay coupon, but they redeem the face value on maturity, and there is a huge discount given on the face value to the investor. What is the benefit to the company which issues this bond? The benefit is that they don't have to pay coupon every year. Is it right? So there is no cash flow obligation for next 25 years. Good for companies which are into infrastructure businesses where you don't have cash flow for some number of years. Benefit to the investor is that he does not have to pay income tax on interest. On maturity, he will pay long-term capital gain tax by using the benefit of indexation. So by using the benefit of indexation, he will pay the taxation. So his tax liability is also reduced. So no interest is paid on deep discount bond during the lock-in period. Difference between the sale price and original cost is treated as capital gain, subject to indexation benefit also. Some of these bonds are listed on the stock exchange also. So where you can sell these bonds. In case if you need money, then these bonds can be sold in the stock exchange also. Similar to deep discount bond is called zero coupon bond. The difference is that in zero coupon bond the maturity is less. Like same example, today you invest 2700, after 5 years you will get 5000 rupees. Same problem, but here the maturity is usually not very high, hence the discount is also not very high, but otherwise deep discount bond and zero coupon bond will work in the same manner. For us, for calculation purpose, I am going to apply the same principle for deep discount bond and zero coupon bond. Here also no coupon is paid during the life of the bond. The face value is redeemed on maturity plus sometimes premium if given. This difference itself is the income of the investor. In this example, the income of the investor is 2300 rupees. Is it right? He will not get separately any more interest. The difference between face value and the issue price is the income of the investor. So for a theory question, I have written additional lines here. You see, why would a company issue zero coupon bond and why would an investor invest in a zero coupon bond? So benefit to the company is that in the initial years, when you are developing a project, starting a business, you don't have cash flow. You don't have enough cash flow to pay interest. So you want to keep minimum cash outflow in the initial year. Hence you can issue zero coupon bond. Okay. And then it is easier to sell these bonds also because you have to tell the investor, see, you invest only 2700 and we'll give you 5000 rupees on maturity. So marketability is better. Issue expenses are lower because the amount itself is lower. So that way the company is able to save on issue expense, company is able to market zero coupon bond well. But what is the benefit to the investor? Why would you invest in a zero coupon bond? The amount to be invested is lower. Instead of investing 1 lakh, you invested 2700 rupees. If you invest a coupon in a coupon bond or a coupon debenture, then you have to pay the full face value today. Is it right? Then you get the tax advantage also. What is the tax advantage? You will be paying the tax using tax rate applicable to long-term capital gain. Okay. And that too after indexation. So one is indexation benefit. Tax rate applicable to long-term capital gain is lower. So tax advantage is there. And this investment is secured against the assets of the company. So these are usually secured instrument. So when you have security, you can sleep peacefully. If company does not repay, then you can recover the amount by selling the asset. So that way the investor is secured. Next paragraph is option bond. You have to turn the page now. Those who are sleeping. What is the option bond? Option bond means you are given two options. You are given two options. That is the option bond. One is called cumulative option and one is non-cumulative option. What is the meaning of cumulative? In cumulative option, if you suppose you tick cumulative, then you will not get the interest every year. Interest will accrue, keep on getting added to the principal amount, and interest plus all accrued interest will be paid on maturity. But if it is a non-cumulative, then interest will be paid every year. Non-cumulative, interest is payable periodically. Okay. Then sometimes these bonds also give you premium to attract the investors. Which company have issued such bonds? IDBI, ICICI, etc. have issued this bond. Now one very interesting bond is called inflation bond. What is the meaning of inflation bond? Interest rate in India on government bond is how much? Do you have any idea? What is the interest rate on government bond? Suppose you invest in National Savings Certificate. or any other government bond. What is the interest rate? Please reply. I don't know. I was sleeping for last so many years. I forgot the interest rate. About 6%. Interest rate is 6%. And what is the inflation? Very high. Tomato is selling for 200 rupees per kg, 180 rupees per kg. So inflation is 8%, for example. If a government of India bond gives you 6%, whereas the inflation is 8%, are you genuinely earning anything? Do you earn anything in this situation? Tell me, are you really earning anything? The answer is no. Your 100 rupees with interest becomes 106 after 1 year. The same goods and service after 1 year is going to cost you 108 rupees. So due to inflation, you are not able to maintain the purchasing power of your money. Is it right? You are not able to maintain the purchasing power of your money. You are losing actually. So then the investor has no motivation to invest in government bond. He thinks that in real sense I am not earning anything. In nominal sense I am earning 6%, but in real sense I am not earning, I am actually losing, I am not able to maintain the purchasing power of money. Is it right? Therefore what he will do? He will not invest. So some governments, what they do, some governments, not Indian government. Indian government is not that charitable. So they will say, we will pay you interest, which will be equal to 4% fixed rate plus inflation rate. Plus inflation. So if inflation is 8%, in that year, we are going to pay you 12%. Is it right? So investor is protected from inflation. That is why it is called inflation bond. So certain governments, they are planning to issue such bonds so that it will protect the investor from the risk of inflation. So in this bond, the interest rate is adjusted for inflation. You get something more than the inflation. So even if inflation is 10%, don't worry, you will get 14% coupon. Thus the investor gets an interest free from the effects of inflation. So the bond issuer compensates you for the inflation. Next is floating rate bond. What is the meaning of floating rate bond? It means flexible rate. Interest rate is not fixed forever. Interest rate will be revised quarterly, half yearly or yearly based on a benchmark rate, based on a standard rate, the rate which will be used for deciding what will be the rate of interest in the future period. For example, the interest rate will be based on RBI repo rate. Okay. As you know, RBI will revise the repo rate every quarter. So if the repo rate is 5%, so in that quarter you pay 5%. If the repo rate is 6% in the next quarter, then you will pay 6. If the repo rate is 7%, you pay 7. If the repo rate is 4, you pay 4%. That is called floating rate bonds. So many bonds in the markets are issued at floating rate. Or another benchmark is LIBOR. Have you heard LIBOR? LIBOR. What is LIBOR? Come on, reply. In international markets, the floating rates are linked to LIBOR. What is LIBOR? Reply fast. Don't mind your spelling, you can write London Interbank Offer Rate. London, L for London, Interbank Offer Rate. That is the rate of interest charged by one bank to another bank in London market. Is it right? London Interbank Market. So that is also used. So LIBOR plus 2% can be the interest rate. If LIBOR goes up, you pay more. If LIBOR comes down, you pay less. That is floating rate bond. So some company prefer to issue floating rate bond so that if the rate of interest falls, they will get the benefit of that. Some investor invest in floating rate bond because they think if the interest rate goes up, I will get more interest. So issuer may be thinking interest rates will fall. The investor is thinking interest rate will rise. So interest rate changes periodically depending on the market interest rate payable on gilt-edged security. Gilt-edged means government securities. Gilt-edged security means government securities. These bonds are also called by other names like adjustable interest bond, variable rate bond. Okay. So in the exam, if they say write a note on variable rate bond, write a note on adjustable interest bond, they are asking you the same question. Now next is option tender bond. Suppose a bond is issued for 20 years. Today maturity is 20 years. Oh my God. Maturity is 20 years, right? You have invested in the bond. Today when the investment was made, the interest rate was 8%, which means for next 20 years you will get 8% interest. But investor is thinking in future interest rate can rise. Yes or no? And I will be stuck with 8% interest. So he wants to keep an option with himself, that if the market rate goes up, I should have the option to surrender the bond, receive my principal amount so that what? I can invest in another bond which will give me higher interest rate. So some companies, in order to attract the investor, they issue option tender bond where the investor has an option. Investor has an option to surrender the bond. Investor has the option to surrender the bond before maturity. Is it right? Investor has the option to surrender the bond before maturity to take the advantage of a higher interest rate in future. So option tender bonds are bonds with put option. These are called bonds with put option. Investor can put the bond back to the company, which gives the right to sell back their bonds to the issuer, normally at par. Okay. These are opposite of callable bond. Have you heard callable bond? I am going to discuss callable bond in a separate section. Callable bond means company has the option to redeem the bond before maturity. Company has the option to redeem the bond before maturity. Option tender bond, investor has the option to go to the company and get his bond redeemed before maturity. More about callable bond in a separate segment. Is it right? Next is, what is the difference between bond and debenture? For us to solve a numerical question, there is no difference. But usually we use the term bond when it is issued by government. Is it right? National highway bond. Yes or no? In your income tax also you have some bond which are issued by power sector companies, highways, where you get capital gain deductions. So bonds are issued by government, government companies, government agencies, state government. Whereas when the same instrument is issued by a private sector company other than government companies, then we call it as a debenture. But otherwise for us there is no difference. This was the theoretical part. Okay. So now tighten your seat belt. We are going to start the numerical questions. Keep your notebook, pen, pencil, calculator, eraser and yourself ready. So the concept is valuation of a bond. Highly tested in the exam, this valuation of bond chapter. So how do we calculate the value of any bond? Whether it is coupon bond, self-amortizing bond, zero coupon bond, perpetual bond, the formula or the logic of every bond is same. It is the present value of future cash flow generated by the bond. The present value of future cash flow generated by the bond is called the intrinsic value of the bond today. And what is the discount rate you will use for present value? The required rate of return. The discount rate to be used for present value calculation will be required rate of return. Okay, so in your book I have given one example, and this last column is pending, so you will fill in the blanks. Last column. Question is, face value of the bond is 1000, coupon rate is 9%, years to maturity is 5 years, required rate of return, this is the discount rate, and coupon rate is the interest amount you will receive on 1000 rupees, and the bond is a coupon bond because it has a periodic coupon plus redemption on maturity. So what is the type of bond? This type of bond is called coupon bond, and the redemption value is 1000 rupees. So what we will do, we will draw one table already printed in the book. You will draw 4 columns: year, cash flow, discounting factor at 10%, and last column DCF or present value. DCF means discounted cash flow. If you don't want to write DCF, you can write present value. Now first write down year 1, 2, 3, 4, 5. First year you will get only coupon 9% of 1000. 10,000, 1000, 9% of 1000 is how much? Is it 90 rupees? And in the last year, be attentive, last year you will get 90 plus 1000, 1090. Then you will write the present value factor. How do you get present value factor? 1 divided by 1.10 on your calculator equal to, you will get something around 0.9091, then again press equal to 0.8264, press equal to 0.7513, press equal to 0.6830, and again press equal to 0.6209. Okay, now just multiply and add. So tell me first number 81.81 memory plus, multiply equal to memory plus, so that total will automatically come in the end. Next one, try 74.38. Next one 67.62. Again next one 61.47. 676.78. Is it right? Now if you have used memory plus function, memory recall, let me see who will give me the answer first here, total. Let me check, online student, who will answer first? Yes, 962. The one who is in the classroom is saying 962. The online students are still calculating. Very good, Divya. 962.05. Very good. 06. Yes, very good. 100 out of 100. So this is called present value of the bond. This is the amount the investor is willing to pay for the bond. It is called intrinsic value of the bond. For a particular investor who wants 10% return, he is going to pay 962.06. He is going to pay less than the face value. Why? He is going to pay less than the face value because he wants 10% return, but the coupon rate is 9. So in order to increase his return, the bond will have to be sold at a discount to this investor whose required return is more than the coupon rate. Okay. Now we'll come to question 1 on the next page. So today we'll solve question. I will request you to keep your notebook, calculator ready. Question 1 in on the next page. Consider a bond of XYZ Limited with the following features: par value ₹100, coupon rate 12%, years to maturity 5 years. Find out the value of the bond if the required rate of return, that is my discount rate, is, there are 3 questions, 12, 14 and 10. Purposefully this is given. In first case 12 are equal. In second case required return is more than coupon rate, and in third question required return is less than coupon rate. So we will be able to understand that what happens when your required return is equal to more than or less than coupon rate. How will the present value of the bond react to these 3 situations? Are you ready? Yes. Then why are you waiting, right? Write down case 1. Case 1, when required rate of return is 12%. Case 1, when required rate of return is 12%. So first you draw this format: year, cash flow, present value factor at 12%, and then present value. Okay. Now first 5 years you will get cash flow. First 5 year you will get cash flow. 12%. First 5 year you will get cash flow. And 5th year you will get the redemption value. And 5th year you will get the redemption value. So how much cash flow you will generate in first 5 year? Each year you multiply 12% of 100. 12% of 100 is how much? 12% of 100 is 12 rupees. In the last year you will get 100 rupees. 5th year you will get 100 rupees. 5th year you will get 100 rupees. So now what you do, dear student, you multiply the factor and the cash flow. Have you computed the factor? Have you computed the factor? Please tell me. Sir, how to compute the factor? If it is annuity, 12 rupees for 5 year, 1 divided by 1.12 equal to memory plus equal to memory plus equal to memory plus equal to memory plus equal to memory plus, and then you press memory recall, MRC. So you will get the factor 3.6047, correct? And the 5th year factor will be 1 divided by 1.12. Just press equal to 5 times. Just press equal to 5 times. Your factor is 0.5674. Your factor is 0.5674. Now multiply and press memory plus function also. 12 into 3.6047 equal to memory plus. Please tell me the answer, students, please. Those who are joining live stream, those who are on YouTube, can you please reply? 43.2564, and the next one is 56.7436. Very good, Divya. Tell me the total. The total is 100 rupees. If you are getting 99.99, that is also right, but you please write 100 because coupon rate and the discount rate both are equal. If coupon rate and discount rate both are equal, then you will get 100 rupees. Okay. So Divya, please make it 100 rupees. Okay, this was case 1. Now I will ask you to solve case 2. Please write down in the notebook case 2. Write down nicely, because one day you have to appear in the exam also, and in the exam I will not be there. So case 2, when required rate of return is 14%, when required rate of return is 14%, draw this table. Yes, please reply, Nitin Patil. Cash flow will be same, factor will change. What is the factor you got for 1-5 here? 3.4331. Okay, next factor for fifth year. 0.5164, 0.5194. Multiply and add. Yes, please tell me the total. Come on. Tell me the total. Everybody. Students online, student in the class. Total of the last column. Multiply memory plus, memory recall. Anybody wants to total? Give me total now. So that is 93.137. 93.137. Please check if it is right. Is it right? Okay. Now try the next one. Case 3 write down. Case 3 write down. Case 3 write down. When required rate of return is 10%. When required rate of return is 10%. When required rate of return is 10%. Format is same. Cash flows are same. Factors will be changing. Yes, reply now. 1-5 10% factor. 1-5 10% factor. Anybody wants to reply? 3.7908. Okay, next. 0.6209. Multiply. 45.489. Again multiply. 62.092. Yes, please total, please. Please give me the total. Divya, Soumya, Hari, Nitin. So Nitin has replied. The answer he has replied is 93.13. Oh my God. I think that was earlier answer. So this is 107.581. Is right? 107.581. 107.581. Check the total. At 10% discount rate, this is the answer. Very good, Hari. Okay. So now what I'll do, I will ask you to write a note. The answer is over, but we are going to write some important observations. So please write down. This question is very good for conceptual understanding, not for exam. They don't ask such easy question in the exam. Otherwise, institute will go bankrupt. Okay. So they will have to issue bond to run their organization. This is for conceptual clarity. So first observation, right? Important observation. First point. When required return is equal to coupon rate. When required return is equal to coupon rate. Please write down in the notebook. Trust me, I have covered this chapter in extreme detail. Everything will be covered in this chapter. And bond is redeemed at par. First condition is required return is equal to coupon rate. And bond is redeemed at par. And bond is redeemed at par, comma. Present value of a bond is equal to present value of a bond is equal to face value. Present value of a bond is equal to face value. Always remember, if the required return and coupon rate are equal and the redemption is at par, it means that the present value is equal to face value. Reverse also, if present value is equal to face value, which means the coupon rate and the required return are equal. So in some exam question they ask reverse question, the current market price of the bond is equal to face value. Coupon rate is 8%. What is required return? Required return will also be 8%. Second observation, right? Second observation is when required return is greater than coupon rate. Our second case, okay? Case 2. When required return is greater than coupon rate and bond is redeemed at par. And bond is redeemed at par. Come on. What will happen? Present value of a bond. Present value of a bond is less than face value. Present value of the bond is less than face value. Present value of the bond is less than face value. Always remember, if the present value of the bond is less than face value, which means your required return is more than the coupon rate. And what was my case number 3? When required return is less than coupon rate. Right, when required return is less than coupon rate. Every small detail you have to write. Okay, because the nature of the exam is now very different. And the bond is redeemed at par. Every minute detail we have to understand. And bond is redeemed at par. And bond is redeemed at par. Present value of a bond is more than face value. Present value of the bond is more than face value. Present value of the bond is more than face value. The third case, this will always happen. Always happen in every problem if these three conditions are there. And one more, fourth line write down. Fourth line write down. What is fourth line? Required rate and present value of a bond. Required rate and present value of a bond are inversely related. Required rate of return and present value of a bond are inversely related. Sir, what is inversely related? What is inversely related? If the required rate of return goes up, the present value of the bond will fall. When we go from 12 to 14%, you will see the value of the bond has gone down. But when the required rate of return falls, the value of the bond goes up. When we had gone from 14 to 10%, the value of the bond has increased. So that is called inverse relationship. Now I am going to dictate this diagram also. Write down this diagram. This diagram shows you the relationship between the required rate of return and the value of the bond. Is it right? Is it a rising slope or a downward sloping curve? It's a downward sloping curve. Okay, which indicates that if required rate of return goes up, the value of the bond will go down. So please draw this diagram. Please draw this diagram and you write the heading required rate of return and value of the bond. The relationship between required rate of return and value of the bond. So on the x-axis you write required rate of return, on y-axis you write price or value of bond, now don't draw a straight line, okay, don't draw a straight line using a scale, don't draw that, because the relationship is not straight line, the relationship is not linear, the relationship is curvilinear, the relationship is curvilinear, okay. Why it is curvilinear? Because of that compound interest effect. This line is a curve because of compound interest. Interest on interest is calculated. Hence the line cannot be a straight line. Is the diagram done? Everybody please reply. Online student please reply. Have you drawn the diagram? Then we'll go to our next question, number 2. Okay. So if you have drawn, we'll go to question number 2. Done. Very good. So question number 2, write down important. And in the class I'm going to tell you which questions are more important, like this one. IMP, important, because they have asked in May 16 exam, November 2003 exam, they will ask you again. The question is, Messrs XYZ Industries is planning to issue a debenture series on the following terms. Debenture or bond, the problem will be solved in the same manner. Face value 100, term to maturity 10 years, yearly coupon rate for first 4 years, the coupon will be 9%, 5 to 8 year coupon will be 10%, 9 to 10 the coupon will be 14%. So this time the coupon amount is changing, 9, 10, 14, and what will happen? The current market rate on similar debenture is 15% per annum. Other debenture, suppose this is XYZ, the other company, call it ABC, they have issued debenture which is carrying an interest at the rate of 15%. The company proposes to price the issue in such a manner that it will yield 16% compound rate of return to the investor. Now this company wants to ensure that our investor earn 16% rate of return, because if I also offer 15% rate of return, then they will prefer to go to the other company. So I must price the bond in such a manner that it will generate a return of 16% for my investor. So my question to this batch of highly talented student is whether to calculate the present value of the bond, are you going to use 16% discount rate or are you going to use 15% discount rate? Please reply. 16. One student in class saying 16. Other student also 16. Very good. This company will price the bond to give 16% return. So I am going to discount future cash flow by 16%. The company also proposes to redeem the debenture at 5% premium on maturity. So redemption value will be 105 rupees. So cash flows will be 9, 10, 14 and in the last year 105. Determine the issue price of the debenture. So I have to discount the future cash flows at 16%, not at 15%. If you discount at 15%, out of 8 marks you will get 0. So write down the answer in the notebook. Heading, write down, every table should have a heading, calculation of issue price of debenture. Calculation of issue price of debenture. Calculation of issue price of debenture. Then you draw this table. Draw this table. And solve. Draw this table and solve. Year, cash flow, PV factor at 16% and PV, present value. Everybody should write the answer in the notebook nicely. First 4 year, the cash flow will be 9 rupees. Then from 5 to 8 years, the cash flow will be 10 rupees. From 9 to 10 years, the cash flow will be 14, very clearly given. And in the 10th year, the cash flow would be 105. Now the question is important, how to calculate the PV factor at 16%. So first you tell me, how did you get 1-4? Anybody? 1-4? So you will take your calculator. Okay. 1 divided by 1.16 equal to memory plus, equal to memory plus, equal to memory plus, equal to memory plus. Memory recall. You will get 2.7982. All clear. Press all clear. Now you will write like this, 1 divided by 1.16. Just press equal to 4 times. 1, 2, 3, 4. Because first 4 I have already used in the first 4 year. Now next 4 times equal to m plus, 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 MRC. So you are getting 1.5454. Is right? Again all clear. First 8 years I have already done. 1 divided by 1.16 equal to 8 times. 9th time equal to memory plus, equal to memory plus and memory recall. So you will get 0.4896. And now the 10th year you can do yourself. 1 divided by 1.16. Press equal to 10 times. So you are getting 0.2268 or something, 22668. Okay. So this is important. Now please multiply and give me the total of the last column. Multiply and give me the total of last column. You will answer, I will check. Yes, please reply. Anybody watching YouTube online, total of the last column. Divya has replied. The total of the last column is around 71.28. How much you got? 29. 71.29 is right. No problem. 71.21. Just check your total again. Otherwise you are right. Now this question was given from the point of view of the company. This question was given from the point of view of company, at what price the company should issue the debenture so that it will give a return of 16% to the investor. But suppose if this question was from investor's point of view, how much investor is getting in the other company? 15%. So investor would expect similar return from this company also. So if the question is from investor's angle, then we would have used 15% discount rate. Is it right? So I am going to solve this question again from investor's angle, because in the next exam the institute will ask you, sir, what is the answer from the point of view of the investor? Okay, so this is extra work we are doing, not a part of the answer, but for future. So write extra work. Something extra will not harm you. If the question is revised in the exam that solve the question from the investor's point of view, you should be able to solve. So please write, if the question is about the price, if the question is about the price that the investor is willing to pay, if the question is about the price that the investor is willing to pay, then use 15% discount rate, use 15% discount rate and solve accordingly. Then use 15% discount rate and solve accordingly. Okay, and solve accordingly. So I am going to solve it again in case if they change the question in the exam. So now write down the table again, write down the table again. Please write the table again. All of you are requested to write in the notebook. Sit with a notebook. We are covering in detail each and everything, line by line, and the presentation is also important for exam. Do not use shortcut. Okay, shortcut will not help you to get through this exam. We have to study in detail, in depth, everything in the study material, RTP, MTP and past exam questions. That is the minimum you have to do. So write down year again 1-4, cash flow will be 9, 5-8, 10, 9-10, 14 and 10th year will be 105. But this time my discount rate will be 15%. This time my discount rate will be 15%. 1-4 factor, please check. How much is that? No, 2.8550 at 15%. At 15% check, 2.8550. Then 1.6323 is right. Right, 5 to 8, 1.6323. Because some students make mistake in the factor also. So even though they know the answer, they will get 0 if you make mistake in the factor. Now come on, next 9-10, 9-10 factor. Please reply. 0.5313. 0.5313. Very good, Nitin Patil. Come on. 10. 10th year factor 0.2472. 0.2472. Now multiply and add. Please write down everything. How to multiply and add? Use memory plus function. Use memory plus function and add. Let me see who gives me the answer first. Whether Divya will give answer first, Soumya will give, Hari will give, Nitin will give, or any other student. So one student has answered 75.4 is the right answer. Everybody should check and confirm 75.4. If the question is from investor's point of view, then you will write this answer. If the question is asked from issuing company's point of view, then the previous answer 71.28 or something. Is it right? Have you understood? Okay. We'll try one more. Question number 3, note down homework. Question number 3, note down homework. Please note down question number 3 as homework. Question 4 Question number 4 now. This question is different. It is based on semi-annual bond. Okay. Question 3 was homework. A rupees 100 par value bond bears a coupon rate of 14% and matures after 5 years. Interest is payable semi-annually. Underline semi-annually. Okay. Semi-annually means interest will be paid after 6 months. So in a year interest will be paid twice. So if the interest rate, coupon rate is 14%, it is for a year. But for 6 months they are not going to pay you 14%. How much they are going to pay you? 7%. Very good. Interest is payable same, and compute the value of the bond if the required rate of return is 16%. But that required rate of return 16% is also per annum. But you are doing semi-annual calculation. So what will be your required rate of return semi-annually? 8%. So here I am going to take 8% discount rate. Here I am going to take 7% as coupon rate, and the number of years will be multiplied by 2, because in 5 years we are going to get coupon 10 times. So number of half years will be 10. So assume that you are in a world which has 1 year is equal to 6 months. Okay. So you have 10 half year, you have 7% coupon rate, you have 8% required rate of return, and solve accordingly. So first I'll give you a small note. Write down everything. Yes, you will be benefited. We have to go very slowly. First today we'll build up the concepts. Then we'll take very advanced question also. We are going to cover everything, don't worry. When interest is payable semi-annually, what you'll do, you will make 3 changes in your calculations. First you will write divide rate of interest by 2. In this example, that 14% will be divided by 2. Then write divide required rate of return by 2. Divide required rate of return by 2. And then write down multiply number of years by 2. Okay. So with that we can solve this. Write down the same table. Calculation of present value of the bond. The first column, instead of writing year, I have written period. Okay, because it's not year, it is now half year, so you can write period, no problem. Cash flow, an important column number 3, I am going to write present value factor at 8%, not at 16%, and present value. If it is 5 full year, it will be 10 half years. So the number of periods will become 10. 10 times you will receive coupon. And after 10th half year, you will receive the redemption value. So every calculation, everything will be based on 10 half year, 7% coupon rate, 8% required return. Solve. Cash flow will be 7 rupees, 7% of 100, and redemption will be at par 100 rupees. Okay. So student will now give me PV factor at 8% for 10 period. 1 divided by 1.08 equal to memory plus 10 times. Then memory recall. Learn to use your calculator also fast. 6.71, approximately 6.71. Very good. Okay, 10th year 8%. Come on, 10th year 8%. 1 divided by 1.08 equal to press 10 times. What is the factor? 0.4632. Multiply, add. Come on, let us see who will answer first. Yes, come on, everybody. Total, whether online will win or offline will win. We'll check today. Whether YouTube will win. Yes. Answer is 93.29. Very good. You are right. Amazing. So this is how you will solve questions of semi-annual bond. Coupon rate half, discount rate half, number of years multiply by 2. Is it right? So everything will be adjusted. Even this you will adjust. You will say, sir, can I write 5 here and can I use 16% discount rate here? The answer is no. Because your required rate of return is also 8% semi-annually for every 6 months. Is it right? So when your required return is 8%, this cash flow will occur after 10th half year. Is it right? This cash flow will occur after 10th half year, and accordingly I am going to take the same factor. Question number 5. Question number 5, everybody please participate. A bond pays rupees 90 interest annually into perpetuity. What is its value if the current yield is 10%? If the current yield changes to 8% and 12%, then what is its value? Is it a coupon bond or a perpetual bond? So in perpetual bond, as you know, only coupon will be paid. So it becomes an annuity. Annuity means same cash flow occurring year after year. And it becomes an infinite annuity because same cash flow will occur forever. Now go back to your happy lucky days of mathematics. What is the present value of an infinite annuity? Do you remember present value of an infinite annuity is A upon R? Have you heard this formula? Seen this formula in your mathematics classes or intermediate FM classes? Yes. So here A means annual coupon, which is 90, and R means your discount rate, which is 10%, 8%, 12%. So this is the question on perpetual bond. And how do we find the present value of a perpetual bond? By applying the formula A upon R. So write down the heading, calculation of present value of perpetual bond. Calculation of present value of perpetual bond. Calculation of present value of perpetual bond. Draw this table. You are given 3 situations. Current yield 10%, 8%, 12%. Okay, so I am going to solve in a tabular format to save our time and space also. Write down. So first you write down formula on the left side. Value of the bond is equal to coupon upon yield percentage. Coupon upon yield percentage. Coupon upon yield percentage. Okay, coupon upon yield percentage. Then you write down coupon is 90 divided by 10%. So that comes to 900. Anybody second column? 90 divided by 8%. Yes, come on Divya. Hari. Nitin. 1125. Okay, now try next one. Divya is right. Next one, Divya, 750. Very good. So this answer is for perpetual bond. Demo problem, okay, conceptual problem. It will be required in advanced questions also. So we have taken coupon bond, semi-annual coupon bond, perpetual bond. Now the next category is self-amortizing bond. Self-amortizing bond. A PSU is proposing to sell an 8-year bond of rupees 1000 at 10% coupon rate per annum. What is the number of years? 8 years. Face value 1000. Coupon rate 10%. The bond amount will be amortized equally over its life. The bond amount will be amortized equally over its life means, what is the annual amortization? Annual amortization will be 1000 divided by 8. So how much amount you will repay every year? 125. Very good. So just write down this in your notebook. Annual amortization. Write down annual amortization is equal to 1000 divided by 8. 1000 divided by 8. Preferably you should watch on the laptop, those who are watching either on YouTube or on the app, so you can see the things very clearly, okay. So 125. Now the question is, investor has a minimum required return of 8%. Before solving, only answer my question. If coupon rate is 10 and required return is 8, required return is less than coupon rate, so what will happen to the present value of the bond? Will it be more than face value or less than face value? Will it be more than face value or less than face value? In the first question we have written a note. If the required return is less than coupon rate, then the present value will be more than face value, because your required return is less, but you are getting more, so you will be willing to pay more price for this bond. Okay, so we have to ensure that my answer is more than 1000 rupees. What is the present value of the bond? So in this question, the interest amount will change every year. Interest amount will change every year. Since the interest amount will change every year, the cash flow will change every year. So I have to compute cash flow of each year separately. Okay. Then compute the present value. So all 8 years I will have to write. So write down in the notebook. Question number 6, note down homework. Please note down question number 6 as homework. Question number 6 as homework. Question number 3 as homework. I have given the answer. You will solve and check. Heading write down. Calculation of the present value of the bond. Calculation of the present value of the bond. So in such question, you have to first make a list of cash flow that the bond will generate. First column, year. Second column, principal sum outstanding. Third column, interest at the rate 10%. Third column. Fourth column, repayment of principal sum. Repayment of principal sum. Fifth column, total cash flow, principal plus interest. Sixth column is PV factor at 8%. Sixth column is PV factor at 8%. Come on everybody. And last column PV, present value. I have written the column numbers also. These are column numbers. Column number 1, 2, 3, 4. 5 will be equal to 3 plus 4. 6 and 7 will be equal to column number 5 into column number 6. Okay, this is an example of self amortizing bond. So first you write down year column 1 2 3 4 5 6 7 8. 1 2 3 4 5 6 7 8 you have written. Now the purpose of this column is interest calculation. The purpose of this column is interest. So first year the interest will be calculated on 1000 rupees. Then you will pay 125. Then you will pay 125, right? So once you pay 125, next year the principal balance will reduce by 125. So it will be 875. Again reduce 125, 750. Again reduce 125, 625, 500, 375, 250 and 125. Okay. Use these numbers and calculate 10% interest, which is very easy. Without calculator you will try. 100, 87.5, correct? 75, 62.5, 50, 37.5, 25, 12.5. Now principal repayment is 125. Write down 125 8 times. Already working note I have prepared for that. Okay, working note I have prepared for that. Now what you do, write down total cash flow. Add these two columns, 100 plus 125, 225, 212.5. Very good. Come on, next. 200. Yes, come on. 187.5, 175, 162.5, 150 and 137.5. Check. Everybody please check first. This is in your interest and write down nicely. This question was asked in RTP. They will ask in the exam also. Factor 1 divided by 1.08. 0.9259. Press equal to again and keep writing the factors. Check it from the screen. After writing, check it. Now multiply these two columns. Multiply these two columns. And tell me the total. Anybody for the total? Yes, those who are attending online, offline, on YouTube channel, would you please reply? Total of the last column. You have to try, otherwise it is just copying. Question is from RTP. This question also write down important. This question also write down important. Yes, anybody who wants to reply? So check the answer now if you have done. The answer is 1070.41 approximately. 1070.41. Is it right? Multiply carefully and tell me the total. So write down this total, you can check later. 1070.41 41. That is why I do the homework myself, bring the answer. Okay. 1070. Yes, Divya is right. 1069.89 is also right. That is okay. 1069, 1070 is okay. Very good, Divya. So can we go to the next question now? Write down nicely. Check the answer later, okay? If you have made a mistake in totaling. Next question is just a small modified version of the previous one. Jagat Industries Limited, JIL, has raised rupees 50 crore through an issue of 9% bond. Each bond has a face value of rupees 500. So this time face value is 500. 10 year is the term to maturity. As per the term of the issue, each bond is redeemable in 4 equal installments starting from the end of the 7th year. Underline this sentence, starting from the end of the 7th year. So you are going to pay in the 7th year, 8th year, 9th year, 10th year this 500 rupees in 4 installment. So what will be each installment? 125. Is it right? Each installment will be 125. First 6 year there is no redemption. From year 1 to year 6 there is no redemption. The redemption will start from 7th year, 8th, 9th, 10th, each year 125. You are required to find out the price of the bond. If the YTM means required rate of return, if the required rate of return is 13%. Okay, once again, before solving only, if required return is 13 and coupon is 9, whether the final answer will be less than 500 or more than 500? Less than or more than? So it will be less than, because your required return is more than the coupon rate. So if in required return is more than coupon rate, the bond will be issued at discount or bond will be bought at a lower price. So I am going to give you the format one more time. Just it's a little different question because there is no redemption in the first 6 years. Okay. Right. Calculation of present value of the bond. Calculation of present value of the bond. Format same. Everybody should participate in the answer. Okay. Those who are at home, keep typing your answer. Year, principal sum outstanding, interest at the rate 9%, repayment of principal sum, total cash flow, PV factor at 13% and PV, present value. Okay. Column number also write down. Column number write down 1, 2, 3, 4. 5 is equal to 3 plus 4. 5 is equal to 3 plus 4. Then write down 6. And 7 is equal to 5 into 6. Okay, so please check. (1-6) we don't have to pay principal amount. So I can write 1-6 together. It will save time for us. Do you agree? Or you want to write all 10 years separately? Not required. So 1-6, 7, 8, 9, 10. Because the cash flow in 7th year, 8th year, 9th year and 10th year will change. So for the interest calculation purpose, the principal sum outstanding write down 500, okay? first 6 year. Then 7th year also 500, because the redemption will happen at the end. Redemption will happen at the end. So till the end of 7th year, 500 was outstanding. Now 125 will be paid. So next year the amount outstanding will be 375 minus 125, 250 minus 125, 125. Now calculate the interest on 500, 45, 45, 375 into 9%, 33.75, 22.50. Come on everybody, last one, 11.25. First 6 year, there is no redemption, so 0. Then you write 125 4 times. Write 125 4 times. Tell me the total now. Total will be 45, 170, 158.75, 147.50, 136.50. Okay, factor now. 13% and 6 year annuity factor. 1 divided by 1.13 equal to memory plus. Equal to memory plus 6 times. Memory recall. Memory recall. So you will get 3.9975. Now 7th year factor, 1 divided by 1.13, just press equal to 7 times. 0.4251 equal to 0.3762, again equal to 0.3329, again equal to 0.2946. Okay. Check the answer first. Everybody please check the answer. Now multiply these two columns. Use memory plus function, and at the end memory recall will give you the total. Multiply equal to memory plus. Multiply equal to memory plus. What is the total? Anybody total? Total of the last column? Check the answer now. Total of the last column is 401.12. Write down 401.12 and later you can check it if it is not correct. Okay, 401.12 approximately. And one important thing keep in mind, when the discount rate is more than the coupon rate, the present value will be less than face value. Okay. Yes, Divya, Hari, Nitin, is it right? So that was about self-amortizing bond. The next issue is deep discount bond or zero coupon bond. Deep discount bond or zero coupon bond do not pay coupon. There is only one cash flow on maturity, that is redemption value, which is usually at par, but it can be at premium also. Is it right? So what I have to do, I just have to calculate the present value of that redemption value. There is no interest calculation, so only present value of redemption value, and that becomes the present value or intrinsic value of a deep discount bond. So I have written in your book also, Next paragraph, student will just note down one homework, question number 9, same problem I have just now done, only amounts are different. Okay, so question number 3, 6, 9, coincidentally table of 3, 6, 9, you will do it as homework. So next paragraph number 12 in the book is present value of deep discount bond. If you see on the screen, it is equal to face value or redemption value upon 1 plus r to the power n, or if you want to use the factor, then present value or redemption value into PV factor. Okay, so just copy this much in the notebook. Copy present value of DDB or ZCB. Present value of DDB or ZCB. PV is equal to face value or redemption value upon 1 plus r to the power n. Or suppose you are given factor, then face value or redemption value into PV factor bracket r comma n. R comma n. Okay, so now we'll take question number 10, 11, 12, which are based on deep discount bond or zero coupon bond. Are you ready? Question number 10. A deep discount bond. In your book, there is a first line which you cancel. Your question starts from second line. There is a small typing mistake. So you will read the question from here. Cancel the first line. A deep discount bond is issued for a maturity period of 10 years and having a par value of rupees 25,000. So the redemption amount or par value is 25,000. And the number of years to maturity 10 years. There is no coupon here. Find out the value of deep discount bond given that the required rate of return is 15%. So you understand in this diagram which I have drawn, we are standing today here. We have to find the present value today. After 10 years, this bond will generate 25,000 rupees for you. So you have to discount it at 15% for 10 years and find out what will be the value today. So the student will now reply. Come on, come on. 25,000 divided by 1.15 and press equal to 10 times. So the first you write the formula. Present value of deep discount bond is equal to face value upon 1 plus r to the power n. Face value upon 1 plus r to the power n. Then you put the numbers there. 25,000 upon 1.15 to the power 10. And then the answer is 6179.55, or you can round off to 60. Very good, Divya. Is the answer right? Nitin Patil, is the answer right? Hari, is the answer right? So this is the answer. One more try will do in question number 11. This was question number 11. What is the price of zero coupon bond having a face value of rupees 1000, redeemable after 3 years, with 14% yield per annum, but there is a note here which says compounded semi-annually, underline, which means what I'll do, instead of taking 3 years, I'll take 6, and instead of taking 14%, I'll take 7. Okay. Second question is same, which we have done just now. In case the yield is 14%, compounded annually like the previous one, what is the price? So write down first case 1, write down 14% per annum compounded annually. 14% per annum compounded annually. Case 1, 14% per annum compounded annually. So answer will be 1000 divided by 1.14. 1000 divided by 1.14 to the power 3. Just try, very easy. The answer comes to how much? 675. Check the answer. Case 2, write down case 2. 14% per annum compounded semi-annually. 674.9 is also right. Now what I'll do, I will take number of years here as 6 year, and discount rate I will take 7% here. Solve. Anybody wants to answer? $1,000 divided by 1.07 and press equal to 6 times. So this comes to 666.34. That is also right. This is also right. Okay, question number 12 is little different. Okay, question 12, little different, pay attention. What is the price of a zero coupon bond today, having a face value of 1000 but redeemable after 9 months? Oh my God. Because all earlier questions were years. This is 9 months. So we are standing today here, and after 9 months you will get 1000 rupees, and we have to calculate present value today. What are the 4 questions mentioned here? The discount rate is 18% per annum, compounded annually, compounded semi-annually, compounded quarterly, and compounded monthly. Is it right? You will be able to solve. So write down first answer, case 1. Case 1, same thing we'll do, nothing different, but 9 months means how many years? 9 by 12 years. 9 months means 9 by 12 years, that's it. Case 1, 18% per annum, compounded annually. Present value is equal to, this is not in the ICI module, this is extra from other reference books. They can ask you anything. This is a professional exam. So you have to be ready with something different. This is a different question because it is in months. So 1000 divided by 1.18 to the power 9 months will be converted into year, 9 by 12 years. 9 months means 0.75 years, correct? So how do you crack this 0.75? Power is 0.75. How do you crack the power as 0.75? So what the students will do, you first type 1.18 on your calculator. I will also try. So type 1.18. Press square root 12 times and press square root 12 times. Don't ask why, these are shortcut tricks. Square root function. Then you press -1. Then you press multiply 0.75, that is the power. Then you press +1 and then you press multiply equal to 12 times. Multiply equal to 12 times. Okay. So you will get some number on your calculator. 1000 divided by that number will be the answer. 1000 divided by that number will be the answer. So how much you got? How much did you get? Please try. If you don't try, how will you learn? 883.26. Please, you can note down this if you want. How did we arrive at this answer? Okay, have you got it? Yes, I am getting the same answer. So basically, in the denominator you will get, I got this number, check 1.13217. Yes, is it right? 1.13217. Yes. This way, if we have to solve with some power like this, which is in fraction, we'll use this shortcut. Okay, it works on your calculator. Now write down case 2. Case 2. 18% per annum compounded semi-annually. 18% per annum compounded semi-annually. Semi-annually means 6 months. So rate of interest will be divided by 2. Okay. And how many years are there? It's 9 months only, not year. So 9 months means how many half years? 1.5 half years. 6 months is 1 half year and 3 months is half of that. So my power should be 1.5 half years. Am I right? So 9 by 6. If it is 12 months, we divide it by 12. If it is 6 months, we will divide by 6. If the number of months are given in the question, solve 1000 divided by 1.09 to the power 1.5. So how do you solve 1.05? Take on your calculator 1.09, press square root 12 times, -1 multiplied by 1.5 plus 1 multiply equal to 12 times. What is the factor you are getting on calculator? 1.13, something more, 137. Okay, not 1000 divided by 1.137. So you will get something around this number, 878.74. or you may get 879. Is it right? Now come to the case 3, write down case 3. Case 3. 18% per annum compounded quarterly. 18% per annum compounded quarterly. 18% per annum compounded quarterly. So quarterly means you will divide number of months by 3 to get number of quarters. So I will write now 1000 PV equal to 1000 divided by 1 plus interest rate is given per annum, so that will be divided by 4. 0.18 divided by 4 to the power 9 by 3. To the power 9 by 3. 1000 divided by 1.045 to the power 3. So this is easy, you can do it. 1.045 to the power 3. Solve, you will get 876.30. Check. Okay. 1000 divided by 1.045, press equal to 876.30. Okay, now the last one. Case 4. 18% per annum compounded monthly. 18% per annum compounded monthly. 18% per annum compounded monthly. 1000 divided by 1 plus 0.18 divided by 12, and number of months will be 9. Number of months will be 9 divided by 1. Monthly means 9 months. Solve. 1000 divided by 1.015 to the power 9. Type on your calculator 1000 divided by 1.015 equal to 9 times. Yes, what is the answer? Anybody please reply. 874.60. Very good. So I have solved a question where they can ask you in months also. How to deal with that I have told you. This question you will not find in the publication of the institute. But if they ask in the exam, you should be able to solve it. Okay. Now we'll come to next concept called dirty price and clean price of the bond. Okay, very interesting concept called dirty price or clean price of the bond. Have you heard? So in the previous 12 questions, question 13, note down homework. So let us see which are the homework. Question number 3, 6, 9, 13. I have given the answer also and you can try. You will be able to solve. Okay, don't worry. If you try, you will be able to solve. So 4 questions are homework. Easy question. You can just check the answer in the book also. In the previous 12 or 13 question, we have computed the value of the bond at the beginning of the year. Suppose this date is 1st January 23. This date is 31st December 23. So if you calculate the value of the bond here, then it is very easy. What you have done is right. Okay. But then you may be given a question where you have to compute the value of the bond between 2 coupon payment dates. So this 31st December 22 coupon has been paid. Next coupon payment date is 31st December 23. But suppose this is 15th July 23. Now the question is calculate the value of the bond between 2 coupon payment dates. Is it right? That is the role of dirty price and clean price. from 1st January to 23, 1st January 23 to 15 July 23, some interest has accrued for this period. Yes or no? Interest has accrued. So the person who is holding the bond in this period, he is entitled for that interest accrued because he was holding the bond. The person who is going to hold the bond from 15 July to 31st December, he should be entitled for interest from 15 July to 31st December. But companies don't pay dividend to different individuals. The company will pay dividend or interest to that party who is going to hold the bond on the interest payment dates. So when we have to compute the value of the bond between two coupon payment dates, we calculate what is called cum interest price and ex interest price. Cum interest price and ex interest price. Cum interest price is called dirty price and ex interest price is called clean price. In the accounts chapter, investment accounting or debenture accounting, in the accounts chapter, investment and debenture, you have studied this concept. Yes or no? That time we used to call it cum interest price and ex interest price, and today we are going to call it as dirty price and clean price. So they will ask you a question, what is the clean price and dirty price of the bond on this date? Now we have to make some changes in our calculations. Is it right? So first we'll see the meaning and then we'll see the process of calculation. What is dirty price? Dirty price of a bond represents the present value of all future cash flow associated with the bond, underline, and includes interest accrued on its next coupon. So this is more commonly known as cum interest price. It will include the price of the bond plus it will include whatever interest which has got accrued till that date. From the last payment date till that date of valuation, whatever interest has accrued, that is also included in the dirty price. And when I remove the accrued interest from the dirty price, when I remove the interest from the cum interest price, what we get? We get clean price. So clean price is dirty price minus accrued interest. So mathematically clean price is dirty price minus accrued interest. And dirty price is reverse, clean price plus accrued interest, and accrued interest is the difference between, accrued interest is calculated from last interest payment date till the date of transaction. In our example, accrued interest will be calculated from 1st January 23 to 15 July 23. Is it right? Now one interesting fact not required for the exam, why dirty price is called dirty price? Dirty price is called dirty price because you see the formula, dirty price is clean price plus accrued interest. Accrued interest will keep on changing every day. Every day interest will keep on increasing. So if every day interest will keep on increasing, the dirty price will keep on changing every day. Clean price can remain constant for some time. Is it right? But dirty price will change. Therefore, in the market, there are two ways of quotation of a bond. There are two ways the bonds are quoted in the marketplace. Just like when you go to buy a phone, they will say 30,000 rupees plus GST, or they may say 34,500 including GST. Yes or no? In both cases you are paying GST, but one is telling you the price excluding GST. GST will be added separately. One is giving you price including GST. Got it? So cum interest price means interest accrued is already included in the price. Ex interest price means interest accrued is not included in the price of the bond. Clean price is more stable, and generally used in the markets to quote the price of the bond. So in the bond market, what is the general convention? The general convention is to use clean price because it won't change frequently. Clean price will not change frequently. Dirty price will change frequently because in dirty price every day the interest accrued will be added. Okay. Now in your book I have written how to find out the dirty price and clean price in the step by step manner. Paragraph number 14, last few lines, very important, write down, very important, because in the exam they have asked this question and those who have not prepared will not be able to solve. Okay, so dirty price and clean price concept is required when you have to calculate the value of the bond between two interest payment date. So I will write the same thing here again. 1st January 23, 31st December 23, and we have to value the bond on 1st July 23. Okay, so we have to value the bond at this point, 15 July 23. So what I'll do, first I will calculate the clean price of the bond on the next coupon payment date. First I will find out the clean price of the bond on the next coupon payment date. How do I find the clean price of the bond on the next coupon date? Suppose 5 years are still remaining. Between 31st December 23 and maturity, 5 years are remaining. So can I not find the value of a bond which has a 5-year maturity remaining? Yes. So I will get the clean price. Okay. Present value of 5 coupon payment and principal amount. But this coupon is also pending. December 31st coupon is also pending because I am standing here. So I will add the coupon of 31st December which is also pending. If I buy a bond here, I will get the coupon of 31st December also. So that gives me dirty price. So I will add the interest and I will get the dirty price. This is my step number 2. So I got the dirty price on 31/12/23. So I have completed step 2. Then I will compute the present value of dirty price on this date. So what is the gap here? July, August, September, October, November, December. 5.5 months gap, 5.5 months. So in like the previous question we have done the present value calculation. I will take this dirty price and I will discount it. 1 plus r to the power 5.5 months are only remaining. So 5.5 divided by 12. So that will give me present value of dirty price on 15 July. Is it right? And if I remove the interest accrued from 1st January to 15 July minus interest accrued will give me clean price on 15th July. So I'll just repeat the step, very important. Those who are watching online, offline, on YouTube, first you will find out the clean price on next coupon payment date. Then you will find dirty price on next coupon payment date by adding the coupon amount. Then compute the present value of that dirty price. So present value of dirty price will also be a dirty price. Present value of dirty is also dirty. And then you remove the interest accrued between last payment date and date of valuation. That will give you clean price on valuation date. This way you do the calculation of clean price on valuation date in case of question where the valuation has to be done between last coupon payment date and the next coupon payment date. This concept we have studied in intermediate accounts chapter, investment accounting, debenture accounting, but that time the dirty price and clean price was not used. They used the term cum interest price and ex interest price, and secondly it was directly given to you, but now you have to learn how to compute it. Okay, so just one more question for today, question number 15. Question number 14 also note down homework. Question number 3, 6, 9, 13, 14. You will try as homework. Any doubt you will ask me. Okay. If you also try simultaneously, you will learn more. Because once a similar concept I have done, you can practice more questions. These questions have been taken from RTP, MTP, past exam. Okay, so it will be very useful to you. So one question for today, question number 15. Consider a bond with following features. Face value is 1000. Coupon rate is 14%. Coupon payable is annually on December end. Underline annually, underline December end. But the valuation date is 1st April 2010. Maturity date is 31st December 2022. Required rate of return is 16%, that is discount rate. Find the full price. Full price means dirty price. Full price means dirty price that should exist on 1st April 2010 and split into accrued interest and clean price component. So you have to find dirty price, accrued interest and clean price on 1st April 2010. Last interest was paid on 31st December 21. Next interest will be paid on 31st December 22, and you are asked to do the valuation on, so just 1 minute. Last interest was paid on 31st December 2009. Next interest is 31st December 2010, and you have to value on 1st April 2010, and this bond will mature on 31/12/22. Okay, so first we'll calculate the clean price on this date 31/12/10, add interest for 1 year, you will get dirty price. Calculate the present value of dirty price on this date minus accrued interest for 3 months, and you will get the clean price. Okay, so I am going to dictate this timeline to you. Write down timeline. This timeline is not required for exam, but might help you in the revision. Question, write down 15, page number write down in bracket, past exam question. This is, write down again, very important question, very important. Please note down, very important. Must revise 1 day before exam. So 31st December 2009 last interest paid. 1st April 2010 is the valuation date. 31st December 2010 is the next interest payment date. And 31st December 22 is the maturity date. Okay, so what will happen? Interest has accrued for 3 months. Next interest payment is after 9 months from the valuation date, and still 12 years are remaining. Yes or no? Still 12 years are remaining, means 12 coupons are remaining. Rupees 140 coupon 12 times you will receive. Rupees 140 coupon 12 times are remaining. Rupees 140 coupon 12 times remaining. So on maturity day my cash flow will be 1000 rupees towards principal and 140 rupees towards interest. So I'll repeat. You have to first calculate the clean price on this date. On this date, I have to value the bond. 12 coupons are pending and principal 1000 is pending after 12 years, and the discount rate is 16%. So here we are right now, and we are going to find clean price by calculating the present value of remaining coupon and redemption. Write down step 1. Only 4 steps are required. Step 1. Clean price on 31st December 2010. Write down the calculation. 100 into PV annuity factor. You can make a table, you can do the calculation by a formula also. 16% comma 12 years comma 12 years plus 1000 into PV factor 16% comma 12 years. 16% comma 12 years. So you will first calculate the annuity factor for 12 year and 16%, which is 5.1971, correct? Plus calculate the factor for 12th year, 0.1685. Solve. What is the answer? Final answer? Yes, anybody? 896.10. This is clean price. But remember, the coupon of 31st December 10 is also pending. This 140 12 times is next 12 coupons. 31st December 2010 coupon is also pending. I will add that also. So that will give me dirty price. So below that write down step 2. Step 2. Dirty price on 31st December 2010. Dirty price on 31st December 2010. You will take the previous answer, clean price, and add coupon of 1 year 140. That will give you 1036.10. This is the dirty price on 31/12/10, and we have to do the valuation on 1/4/10. So I have to calculate the present value of this, and what is the gap between these two dates? 9 months. So I have to calculate present value by discounting it by 9 months. So write down below step 3, dirty price on 1st April 2010. Dirty price on 1st April 2010 is equal to 1036.10 divided by 1.16 to the power, it's 9 months, so 9 months will be divided by 12 months because it's annual rate given to you, 9 by 12. So that will be simplified. First you simplify that, 1036.10 divided by 1.16 to the power 0.75, and I have told you how to solve it. Type on your calculator 1.16, press square root 12 times, minus 1 multiplied by 0.75 plus 1 multiply equal to 12 times. What is the factor you are getting? 1.117. Okay, divide, check the answer. Yes, Divya, what is the answer? 926.95 approximately. Say yes or no. 926.95. And now the last part is to find out the accrued interest and clean price. So write down step 4. This amount of rupees 926.95 includes accrued interest for the last 3 months. Includes the accrued interest for the last 3 months. Includes the accrued interest for the last 3 months. Approximately, you are right, Divya, 927.57 is also okay. Somewhere close to this number is okay. Not too much difference. So what is the accrued interest? Accrued interest will be calculated using coupon rate on face value, like your accounts classes, 1000 into 14% into 3 by 12. 1000 into 14% into 3 by 12. 35 rupees. So now write down clean price on 1st April. Clean price on 1st April will be dirty price. Whatever you got, you write it here. This number, if you have got, write here minus 35. So tell me the answer approximately. How much you are getting? 891.35. 891.35. And those who have got this answer, they will deduct 35 here, and their answer will be something like 892.57 or something. Just check. So these two answers are okay. Because of rounding off, some difference is possible. Is it right? Any query on this? No query. Understood? Enjoyed? Did you enjoy? Those who enjoyed will write yes. Okay. So thank you very much. See you tomorrow at the same time. Okay. Bye bye. Take care.